Greetings, my dear student. This is Balakrishna again from BALAS Accountancy Special Classes. Welcome to my 38th episode. In this episode, I'm taking up a new chapter, accounts from incomplete records, or in other words, single entry system. Okay. Well, all along, we have been basing on double entry system of accounting, wherein basically the entity concept. I repeat, the entity concept. That is, business and businessman is different. We consider that account everything from the point of view of the business only was the paramount principle involved. Okay. In other words, double entry system of accounting is fundamentally based on this entity concept, and also a lot of assumptions, generalizing techniques, ledgerizing, drawing a trial balance, and eventually preparing the financial statements, etc., where the steps we adopted, and that too is very systematic and scientific method, is it not? But my dear students, layman may not be able to comprehend this scientific method of double entry system. However, he too will be eager to know what has been his final profit during the year, and also how does he stand with his various assets and liabilities at the year end. Okay? Or in other words, what has been his final statement of affairs, otherwise called balance sheet under the double entry system, on a particular date, based on the limited accounting what he has done. He is able to list out the basic values of various assets and liabilities as on a particular date, say at the year end. For example, he will list out like this. These are the various assets. These are the various external liabilities. Okay. We know that assets minus external liabilities is the capital. Okay. Assets minus these two external liabilities is the capital. We know that well. Is it not? And that is what the very accounting equation is all about also. This statement of affairs prepared on the closing date of last year is nothing but the opening statement of the current year. Common sense, na? Yesterday's balances are nothing but today morning's balance. Is it not? Yes. In this way, he is able to know his opening capital. So opening capital he has found out. In case of a newly started business, means it is still easier. Okay, the story starts with the capital amount itself, and as such, it is straight available. Okay, somebody will introduce cash so much, bank so much, assets so much, goods so much, or cash only, and the capital amount is whatever he has introduced. So we can easily find out the opening capital. Okay, having got the opening capital amount, he can prepare a closing statement of affairs in the similar way and arrive at his closing capital also. Okay. Similar way, he can prepare. He can just list down the assets and external liabilities and find out the closing capital amount. Difference will be the closing capital amount. Okay. Now, let's assume that his opening capital is 3 lakhs. Okay. How he has got it? He just listed out his assets and liabilities, and the difference he found as 3 lakhs. Okay. Let's assume like that, right? And he has not introduced any further capital during the year. In that case, his capital would have gone up. Nor has he withdrawn any capital or made any drawing during the year. Okay. In these both cases will reduce his capital. Let's assume that without any of these events, which will increase or decrease his capital during the year. I repeat, without the happening of any of these, he arrives at the closing capital as rupees 3,40,000. Okay. This also he has arrived at. How he has arrived at? At the year end, he must have listed down assets and external liabilities. Okay. Is that clear? That means he has arrived at this amount by preparing a similar statement of affairs at the year end. Obviously, he has made a profit of 40,000. Okay. 3,40,000 is the closing capital minus opening capital, 40,000 profit. This is the very fundamental thing about single entry. Okay. How one find out his profit. Okay. However, if there are introduction of capital, drawings, etc., during the year, the same has to be adjusted with this closing capital, and thereby he will get the adjusted closing capital. Let us take this same thing as an example. His closing capital was 3,40,000. Let's assume there was a drawings 50,000. It has to be added back. Why it has to be added back? Why it cannot be deducted? Simple like that. Had he not withdrawn this 50,000, his closing capital would have been more to that extent. That's why we are adding it back. And the reverse logic apply for capital introduced 75,000. Had he not introduced the 75,000, he would not have had this much closing capital. Okay, hence it is deducted. And I'm getting my adjusted closing capital of 3,15,000. From that, as usual, I am reducing my opening capital 3 lakhs. My profit has become 15,000. So this is a standard format of it. Closing capital, added drawings, less additional capital introduced. We get the adjusted closing capital and reduce the opening capital, the profit. This need not be essentially his net profit. For that purpose, he needs to adjust those non-cash items. What are those? Which increase in the expenses or losses and necessitate a deduction. Those non-cash expenses. Okay. That will increase your expenses or losses. Which are all those items? Depreciation, outstanding expenses, interest on capital, interest on loans, provision for doubtful debts, etc. Okay. Similarly, there are those adjustments which result in increase in incomes and gains and must be added to arrive at the net profit. Okay. They has to be added. Previously we deducted. Examples of such items are prepaid expenses, interest on investments, etc. Okay. From this profit, certain items will be added and certain item will be deducted. That's what I mean to say. As always, please note that, as always, these adjustment items are recorded at 2 places. Okay. It's better I switch over to my sharing session when I will be able to put it across more effectively. Thank you. Well, students, single entry system, which is otherwise called account from incomplete records. In fact, there are 2 methods. One is statement of affairs method. There's yet another method, conversion method. I have not at all discussed anything about it in this class. It will be done in the subsequent classes. Let us stick to the statement of affairs. I will be explaining this format completely, followed by a sum, a practical sum, so that you will be thorough with it. Well, step number 1, prepare statement of affairs at the year beginning for calculating opening capital. Step number 2, prepare statement of affairs at the year end for calculating closing capital. The method will be simple. I have just now shown over the whiteboard behind me. What is that? Asset side, values, whatever you have, we know, you list down. Similarly, the liabilities also, and you'll get the assets minus liabilities, the capital, the respective values, year beginning values and the year end values will show in the respective statements. Okay, fine. And step number 3, prepare statement of profit or loss for calculating net profit. This is the format. Statement of profit for the year ended. Closing capital at the year end. We have calculated here now. Show the amount here. And drawings will be given to you. They may directly give cash withdrawal or any kind of removal from the business for personal purpose will be considered as drawings. Okay, sum it up and show it here. And this plus this is the figure. Okay. Now, less additional capital introduced. They must have told he borrowed some money and introduced. That borrowed part and I think you are not bothered. Introduce additional capital. That you show. Make a deduction. And the opening capital, what you have arrived at here. Okay. That also make as a deduction. You will get at this stage profit before adjustments. Okay. Now, deduct those adjustment items that reduce the profit. I already mentioned some items. Similarly, add those adjustment items that increase the profit. And you will get the net profit. This is the final profit. Okay. However, he'll continue to maintain a final statement of affairs at the end, in the way it is done in the proper double entry method, a balance sheet. However, balance sheet we did it through generalizing, ledgerizing, trial balance, and like that. But here in this way he'll come and finally he'll make it. Each adjustment will be shown here also in two places. One at the face of this statement of profit, one part of the adjustment. Second part will be incorporated in the or adjusted in the final statement of affairs. That is nothing but a proper balance. So double entry is taken care of here. Any adjustment has to be shown in two places. That will be ensured here. Okay. And this is nothing but this at par with a balance sheet in case of a double entry method. Things will be more clear to you when I work out one practical sum for you. Let us take up one sum now. Thank you. Well, students, the practical question number 31, page number 23.56, DK Goel, edition year is 2019. The question is like this. Following information is available from Sachin, who maintains books of accounts on single entry system. Right. So, cash and bank, sundry debtors, stock, furniture, sundry creditors, loan. So 4 assets and 2 liabilities. Respective values of the year beginning as well as the year end have been given. Followed by information. Sachin withdrew rupees 5,000 from the business every month for meeting his household expenses. So drawings, 5,000 into total 60,000. During the year, he sold investments held by him privately for rupees 35,000 and invested that amount in his business. Well, all this information we are not bothered. He has introduced capital 35,000. He must have borrowed it from somebody, he must have sold his land or investment or some ornaments, land, something. That's all, we are not bothered. He has introduced 35,000 capital, that's all. Now, at the year end, certain expenditures are pending. Depreciation to be allowed, and shop assistant was to be given some amount. And of course, fully interest on loan is also to be accounted. So these are all comes as adjustment entries. It will come in the face of the statement of profit as well as we will show again in the final statement of affairs. So two places it will be taken care of. Fine. Now let us start with the preparation of opening statement of affairs, 1st April. Given figures have been shown here. And check it. Okay. All these figures respectively are shown here. Okay. Difference amount is nothing but opening capital, balance figure. Ditto way I prepared for the year end also. Given figures have been reflected there respectively. Okay. And the difference is my capital fund 83,000. Now let us prepare the profit or loss statement of profit or loss. Step number 3. Closing capital. We have found just now 83,000. Let us check whether this is agreeing with the answer. What? So also yes, closing capital 80,000. Opening capital 44,000. We too have got 44,000. Okay. That also I am showing here. Anyway, drawings already explained 60,000. I am adding it. I am reducing, deducting the fresh capital introduced 35,000. Okay. I am getting 1,08,000. They are categorically told now. 35,000 invested. Okay. Yes. Then from this figure, I am reducing. This is my adjusted capital. Okay. This is my adjusted capital. From this, I am adjusted what capital? Adjusted closing capital. Yes. From this, I am reducing my opening capital, 44,000. I am getting 64,000. And this is not the final figure. This is profit before adjustments. And interest on loan, 30,000 was the loan amount, 10%, 3,000. depreciation. 29,000 was the value of the furniture unchanged. No purchase of furniture. Okay, so very easy for us to calculate. So 2,910%. Shop assistant share. What they have told about shop assistant share? Shop assistant was to be given a share of 5% on profits ascertained before charging such share. So 64,000 at this stage, profit before adjustment, minus first adjustment, second adjustment, we will get 58,100. On that 5% comes 2,905. That is also yet another expenditure. Sum of all these three comes 8,805, and that being the case, this minus these adjustments will get 55,195 as a net profit. Let's see whether, yeah, that also they have agreed. Now the last step, final statement of affairs. How to go about it? You base on the final closing statement of affairs, and only those items that needs adjustment, as has been shown in my profit and loss, or at least needs to be adjusted and put the net amount. Otherwise, as it is. Okay. So these three items I'm showing as it is, and furniture subject to depreciation. Right. So it has come. Now, sundry creditors, 22,000. I'm showing it as it is 22,000. Loan is 30,000. However, subject to interest payable. How much? 3,000. So this is the latest value of the loan. And outstanding expenses, we have already calculated. This shop boy is to be given 2,905 payable, is it not? So that liability also comes here. Now capital conventional way we have to do that. Opening capital given, net profit, we have already found the net profit 55,195. Add to that, now 99,195, and add fresh capital also 35,000. Okay, we know that now fresh capital is there very much, 35,000. Okay, so that also we added, and less drawings. Drawings also we are shown here, no? Yes. That's all. So he has prepared a final statement of affairs that is nothing but ditto of a balance sheet as is prepared in case of a double entry system. Let's check whether this amount is agreeable to the order. Yes, that is also correct. Well, students, we are taken up today the statement of affairs method under single entry system. And one sum also we have worked out, one practical sums. Okay. There is yet another method, conversion method, and more sums also we need to work out. That all will be done in the episodes ahead. Till then, please take care of yourselves. See you. Thank you. Thanks a lot.